It seems like Jake Claver knows precisely when XRP is going to burst. He just dropped a bombshell that is shocking the XRP community to its core. With these clips in hand, people have started inundating my direct messages with the question, is this it? Am I witnessing history? So I figured, what the heck, let's go right in. Pure and unadulterated. We may be witnessing the quiet before the greatest move in XRP history, so let's review everything that has been spoken recently and put it all together. This XRP millionaire blueprint lays out all the details you need to know about the setups, timing, strategy, and positioning that the top 1% are using right now. This is my exhaustive step-by-step manual on how the world's wealthiest investors are getting ready for the next big financial revolution. You may find the link in the comment that is posted below this video. Okay then, let's begin. In the first segment, a somewhat daring question is posed to Jake Claver. Hey legend, do you have any inside information regarding XRP and its expected timeline that you can't share with us? With a mischievous grin on his face, Jake ignores the question, expresses gratitude for the great conversation, and then continues on. His reaction, though, is what really grabs my attention. What he knows is not fit to be shared with the public. Whether it was a non-disclosure agreement or sensitive material, the tone conveyed it all. In a subsequent video, Jake reiterates the rapidly depleting XRP reserves and stresses the importance of comprehending the mechanics underlying the impending supply shock in order to arouse the market. He is correct, too. All the big names in the industry have been talking about how XRP is going away from exchanges recently. Limits are being imposed. We've witnessed exchange wallets disappear. Business tables that deal in open trading are becoming hot. Additionally, the ordinary investor will find XRP less liquid as this trend persists. Jake tells it like it is. For nearly 15 months, he has repeatedly brought this up in conversation. And his main point remains the same. I wouldn't keep coming back here if this wasn't guaranteed, he says. That is unwavering faith. Furthermore, it is no longer considered guesswork when a prediction remains unchanged for 18 months, despite the data consistently supporting it. It's in harmony. Things are about to become crazy now. Jake brings up the topic of the national debt and how the information age could lead to a solution. He breaks things down into the most basic terms imaginable. U.S. debt is through the roof and the country has enormous responsibilities. However, they may be able to offset their obligations with hidden digital assets. For example, a large amount of XRP that has never been audited publicly that appear on their balance sheet. Resolving all of the debt is not the point. Keeping the books in balance is the key. This is when the concept becomes intriguing. Reason being, as Jake says, the exact amount of cryptocurrency held by the United States government is a mystery to everyone. What we do know is that they had Bitcoin that they sold at auction. But after that, not a single thing. Nothing has changed even though we are halfway through the year. I find it strange. The lack of sound may be revealing as well. After then, Jake explains the situation. What would happen if the government owned XRP in large quantities through strategic allies like BlackRock or specific financial agencies? Instead of for fun, how about using digital assets as collateral to restructure the nation's debt? So long as they don't crash the system, they can keep their position as global leaders. The reasoning is flawless. The government has served as its own bank for many years. Aside from printing, they also borrow and lend. However, printing will become obsolete after the full integration of this new digital monetary layer. There will be a tokenized value. The genuine key is dropped by Jake thereafter. Revaluing it manually is unnecessary. David Schwartz, chief technologist at Ripple, has previously stated that no one has the power to establish a hard cap on the price of XRP. Such a step would necessitate international law in all the main nations. As things are, it's not even legal. However, a price announcement by the government is unnecessary. The work can be done by market dynamics. Demand skyrockets when supply becomes scarce, and money flows out of retail markets and into institutional corridors. A huge amount of money can be found through natural means. Jake is essentially arguing that they can naturally orchestrate catalysts to initiate that reassessment. There might be tremendous benefits if that materializes. The mathematical example is applied by him. A 700x rise would occur if XRP's value jumped from $2.50 to $2,000. The number is not at random. It's based on the potential value of digital assets to pay down U.S. debt. His claim that they can use it as collateral for loans and debt repayment is not fiction. Every single day, that is the same strategy that institutions employ, creating liquidity through the utilization of assets. That is his point about governments acting as their own bank. It is a control loop, and they must not wait for the system to fail if they desire to maintain their position as the world's leading digital company during the transition. The change must be engineered by them. Ripple is useful in that regard. The foundation of the business is a mechanism that connects the old financial system to digital liquidity. Therefore, XRP would serve as the asset to bridge the gap in a regulated transition. Once again, Jake detonates a bomb. You might establish a firm, perhaps in partnership with BlackRock and others, to guarantee that you would maintain your position as the world leader during this change. You can't just say that. Digital assets, tokenization, and liquidity management are already areas where BlackRock is making moves. They aren't playing around, they are constructing systems. We then get a different footage. Jake explains why XRP isn't your average investment, a wealth event that spans generations, he says. And his words carry an emotional weight. He's witnessed individuals in different fields amass fortunes that change their lives, frequently using dubious methods. Here, though, he thinks invention is the driving force. With unwavering conviction, the tone is set. In his lifetime, he claims, there will be no such opportunity again. That, I think, is the secret to his message's widespread appeal, because there has never been a convergence like this before in terms of setup, timing, infrastructure, and regulatory clarity. There is no way to make that setting again. The story gets more intriguing from here on out. A footage mentioning a fresh White House announcement, a new golden age for the U.S.-Japan alliance, follows Jake's remarks. The United States and Japan signed an agreement on October 28, 2025, to enhance commerce, technological development, and economic security. Plus, a $550 billion Japanese investment fund is supporting it, with the goal of bolstering U.S. industry. That's a lot of money going across borders. It's not little change. Let us be clear, those documents do not officially mention Ripple or XRP. Ripple has been working toward this kind of environment for a long time, and it becomes clear when you consider the scope of this alliance. Critical minerals, advanced technology, and economic security frameworks, what it actually covers. Because at stake here is not only blockchain technology, but also the new system's financial infrastructure and the identities of those with control over its value pipelines. At that point, Deanna gives up. Any news on the XRP liquidity? Reasons why selling XRP at the peak could be challenging, that is correct. Jake has personally cautioned about this matter on more than one occasion. Most retail traders think, I'll just sell at $10 when XRP moons. When market liquidity is low, though, that won't happen. Nobody can sell at the same time in this market since there aren't enough potential buyers. The term for such is slippage. Plus, it's not always pretty. Jake makes an excellent comparison. If the fire alarm were to go off in a large music hall, everyone would have to make a beeline for the one little escape. There isn't enough room at the inn. Liquidity, he elaborates even more. Retail traders aren't the ones that sell or purchase for institutions. Their business model is based on OTC markets, which are transactions that do not involve exchanges like as Kraken or Coinbase. Corporations' payment systems will absorb an even greater amount of XRP liquidity after Ripple's acquisition of G-Treasury. While that's fantastic for practicality, it indicates that the public float is continuing to decline. The irony is that liquidity becomes more of a problem as adoption increases. The result can be a price surge that is both more severe and quicker than anyone could have predicted. However, you'll need a plan to cash out. That is why, according to Jake, being proactive is crucial. Remove XRP from exchanges, establish limit orders in advance, and plan your exit strategy before the mayhem starts. Simply put, those who predicted XRP's peak will not be the ones to benefit when the price finally turns vertical. Those individuals will have been prepared for it. Finally, as the tension rises, the clip ends. Jake claims we are at the front door of an XRP price of $10. He doesn't provide a certain date, but he does suggest it's going down soon due to changes in the energy market, macroeconomic trends, and the domino effect. It's a chain reaction that, once set in motion, most people won't have time to respond to. And the timing couldn't be more ideal. It falls just before Ripple's big conference. A few minutes ago, Litecoin and HBAR ETFs were live. The ETF approval procedure is continuing unabated, even though the government is taking its sweet time. It seems like a coordinated rollout is about to happen. So, as the general public watches for news, those on the inside are making moves. That is why the whole thing, all the alliances, the changes in liquidity, and the supply shocks feels like the build-up to the breakout. Simply said, it's a significant market upswing when it occurs. Resetting the system is what it is. Moving on, let's delve further. Just because what you see on the surface doesn't reveal everything. Everything that Jake Claver has been hinting at starts to make sense when you see how what's happening behind the scenes combines liquidity, policy, and time. We'll begin by discussing the psychology of time. In most people's minds, when they hear the term XRP explosion, a single monumental announcement or trigger causes the price of XRP to skyrocket all at once. However, the actual detonation occurs in increments. Accumulation is the first step. Positioning oneself silently and strategically while public opinion is low and focus is elsewhere. Therein lies the role of institutions. Not even green candles will entice them. Through routes that do not affect public charts, they make large, covert purchases. And that is the pattern that has been emerging recently. Significant shifts in the market, increasing amounts traded over the counter, and a trend toward private wallet consolidation. Feeling anxious is not the same thing. It's the first step. The astute investor's money moves silently. Assemblies are made. Join that with the current events occurring on a global scale. A cash issue has arisen as a result of our mounting debt. The demand for efficient cross-border value transfer has never been higher. Governments can't print forever, and budgets are being eaten alive by interest charges. That is not an abstract concept. That is the truth. This is the moment is not just hype, according to Jake. It's all about the macroeconomy finally catching up with the developed tech. The system developed by Ripple stands for exactly that, a prepared foundation for the subsequent monetary layer. Institutions can settle huge sums in seconds with complete transparency and compliance because to XRP's design, no new invention is required for it. It is currently operational and awaiting approval from relevant regulatory bodies for worldwide integration. Jake brings up the domino effect frequently, the notion that other countries or institutions will be compelled to follow suit once a major one completely adopts digital settlement on the XRP rails. Efficiency becomes a competitive advantage, not because of ideology. As soon as a faster channel begins to carry liquidity, the remaining nodes in the network adapt. Price increases at an exponential rate at that point, not through retail speculation, but rather the expansion of liquidity driven by utility needs. Consider it in this way: the opening of more corridors, the integration of more treasuries, and the clearing of settlements in seconds rather than days all set off a domino effect. That momentum is impossible to turn back once it gets going. The effect is amplified. Currently, one of the most intriguing possibilities is Jake's suggestion that the government may have digital assets on their balance sheet. We already know that big government entities store digital assets, regardless of whether it's XRP or not. Governments throughout the world have started seizing and liquidating crypto assets. The United States Marshal Service has dealt with billions of dollars worth of cryptocurrency, and the United States Treasury has also done so. Do they own digital assets? That isn't the main concern. They're keeping track of them in this way, for the simple reason that they may be sitting on a mountain of untapped potential if they are priced at cost instead of fair market value. That is leverage in the context of a debt crisis. That governments could take out loans against such assets to shore up their finances is related to what Jake stated. Said another way, they wouldn't have to sell. They'd put them up as security, much as when you borrow money against your home or car. So what's the catch? Governments have more flexibility with digital assets than with gold or real estate because of its instantaneous transferability, fractionalization, and pledgeability. This highlights the critical nature of the forthcoming regulatory frameworks. Digital assets can attract sovereign wealth, institutional funding, and interbank liquidity once transparent regulations regarding their custody, valuation, and collateral are put in place. Plus, which asset is tailor-made for that specific setting, XRP value? Jake's statement is not about manipulation, it is about the ability to organize catalysts. Design is the key. When change-inducing catalysts are released into a pre-change environment, the markets react. Consider how the announcements of the BRICS digital currencies, the worldwide CBDC pilots, and the current alignment of Western regulatory frameworks all happened at the same time. That is all by design. Sequencing is the key. The acceleration effect, in which seemingly improbable price moves really materialize, occurs when sequencing enters the execution phase. For that reason, Jake can't stop saying that this scenario will happen. Retail charts are not what he is referring about. System architecture is what he's referring to. Having established that, we can tie it to the liquidity alerts that he and Deanna have been discussing. The general public believes that a liquidity issue indicates a price decline. However, such is not the case here. There will be insufficient XRP on hand to satisfy demand once adoption occurs due to a liquidity crunch on the supply side. A perfect storm has occurred. If there is a sudden increase in demand and a decrease in supply, the price discovery process will be vertical. Jake cautions that selling isn't as easy as it seems during such spectacular moments. The price you see on screen might not be the price your trade settles at due to substantial slippage caused by thin order books. Retailers may inadvertently drive down their own exit pricing if they rush in to restock. Institutions that trade in negotiated blocks through over-the-counter methods, meanwhile, avoid all of that. For that reason, preparation is key. What differentiates runners from spectators is having a plan in place before the run starts. Jake is persistently attempting to inculcate that mentality change, transition from responding to getting ready. Additionally, Ripple Swell is associated with a time component. Swell serves as an annual low-key checkpoint, a platform for Ripple to highlight collaborations and institutional advancement. I feel like it's different this year. The buildup has been more understated, but things are coming together in the background. Applications for exchange-traded funds, trials of tokenization, and cross-jurisdictional regulatory cooperation. For that reason, many are treating the days leading up to Swell like a ticking clock. There is no meaningless goal price when Jake says 10 XRP is within reach. You may say it's symbolic. This is all about the change from idle utility to active liquidity. Once that switch is turned on, all the corridors that have been subtly constructed will be revealed. When that happens, everyone else finds out what has been going on behind the scenes. Keep the broader view in mind. Governments are working on real-time reporting systems for cross-border transactions, firms are incorporating blockchain-based treasury tools, and central banks are piloting digital settlement frameworks. This whole thing necessitates liquidity bridges. As a bridge between fiat, digital money, and tokenized assets, Ripple has positioned XRP to do just that. When Jake claims they're still ahead because they're orchestrating it perfectly, he means exactly that, for the simple reason that modernizing global financial domination is more important to the United States than losing it, so they're actually helping to shape blockchain rather than opposing it. The evidence is BlackRock's actions in tokenization. They have no intention of making yet another speculative cryptocurrency product. Actual assets are being digitalized. The necessity for liquidity channels has led to the transformation of bonds, real estate, and commodities into on-chain assets. Additionally, compliant immediate settlement is required for the rails that transport these assets across borders. That's the direction XRP was intended to go. Let us get back to the relationship between the United States and Japan that Jake mentioned. Economic cooperation is what it appears to be on paper. However, at its core, the issue is one of technological independence. The two countries are cognizant of the fact that the digital financial infrastructure will determine the course of international trade in the 21st century. Japanese financial institutions were among the first to use RippleNet, including SBI and others. More than just commerce is signaled by the $550 billion investment framework. Funds are being redirected to build up the infrastructure of the digital economy. For that reason, the timing is critical. The future of finance is being built in real time, even though most news reports focus on politics. The current is changing, and you can see it if you know where to look. Liquidity corridors, bank integrations, private ledger pilots. Having grasped this macro backdrop, Jake's point regarding generational wealth becomes more impactful. He is referring to more than just a fortunate trade. Being in the correct place at the right time before anything becomes the norm is what he means when he talks about alignment. Changes in wealth occur in that way, not based on speculation, but on preparedness. What differentiates individuals who enter during the chaos from those who enter during the calm is their level of preparedness. The noise phase is currently ongoing at the moment. Disarray has ensued in the public discourse, legislation is in its early stages, and focus is uneven. There is a window of opportunity there. The easy phase of accumulation will end once clarity emerges and the world witnesses XRP settling real-time transactions for major institutions. For that reason, Jake's unwavering belief comes over clearly. His claim that he has been rightfully vindicated for the past 18 months is based on the fact that each new development, corporate relationship, and liquidity report has consistently confirmed his previous conclusions. At that point, the issue becomes more significant than XRP alone, for the simple reason that XRP is merely a connecting link in a very large network. Tokenized assets, commodities, CBDCs, and cryptocurrencies are just a few examples. When those connections go operational, worldwide liquidity may be controlled. Then, instead of just going up, the value of bridge assets is adjusted to reflect the increased volume they are transporting. That is the meaning of Jake's statement that the revaluation is being done by market dynamics. Once digital trains begin to carry trillions of dollars, it will be the market, not the government, that finds a new equilibrium, not the other way around. Now add in the field of retail psychology. When news breaks, there's a frenzy to get back in, a search for the next rally, and a fear of missing out. A parabolic phase is formed, as you can see. There is no randomness to it. The result of years of compression is an energy release. Plus, we're located nearby. It is palpable. The stillness just before the cacophony, the pre-headline settings, the building as it stood anti-storm. In the event that a regulatory notification, a significant activation of a corridor, or an unexpected liquidity event sets off the first domino to fall, it will be more than just a blip on the chart. It will be the exact moment when the new system becomes visible to everyone. The ones who have been keeping an eye on things, getting themselves in place, will be the first to ride it. Money advice is not what this is. The silent accumulation is now underway, and no one is talking about it. Unveiling tokens and ETF speculations continue to dominate headlines, while the true story is taking place behind the scenes. Even large financial institutions that previously wrote off XRP are now covertly establishing connections to RippleNet. It's not immediately obvious, but it's there in the transaction data for payment corridors, custody partnerships, and liquidity nodes. Let me tell you the truth. No one at an institution waits for permission. It is inevitable, therefore they are ready for it, in anticipation of the throng they construct. And at this very moment, that is taking place. The time is absolutely ideal. An instantaneous and inexpensive bridge asset is required by global settlement systems to facilitate the rapid tokenization of real-world assets. XRP's design was specifically for that purpose. Programmable liquidity is what it is. Turning resistance into flow is the job of infrastructure. When other financial institutions, including as banks and exchanges, join this ecosystem, its impact is magnified. Instead of growing linearly, the value of a network grows exponentially with each new link. That is the application of Metcalfe's law. Because of this, interoperability has always been the first priority in Ripple's design. Increasing the price was never the goal. It had to do with driving the trains. However, things start to go crazy now. They don't take baby steps as liquidity channels begin to develop. Their position changes. Complete systems are abruptly redirected. The volume cannot be changed once that switch is turned on. Just like that, a digital asset goes from being a niche item to an essential one. It's about to happen. We're at the cusp of that turning point. The move from if to when in retail mood, the tone of regulatory debates, and Ripple's announced partnerships are all indicators of this. No longer is this hopium. There's a meeting of forces between momentum, mechanics, and mathematics. Speculation will not be the focus of the following phase. The resolution is at hand. Whoever grasps that distinction will move quickly to position themselves before the rest of the world catches wind of what's happening. There will be no time to get in after the financial system resets around tokenized value. The infrastructure is set up, the funds are secured, and the process is starting. Therefore, the most astute financiers aren't pursuing irrelevant data. They're majoring in building design.